Bloomberg Audio Studios.
Podcasts, radio, news.
I'm going to start this episode of Merryn Talks Money with another reminder for all of you Merryn Talks Money listeners. I have launched a weekly Merryn Talks Money newsletter. It is the place, the only place, well, except for John's newsletter, of course, to get micro to macro thoughts on your money and investments. The second one hits your inbox on Saturday. It's for Bloomberg subscribers only, so be sure to sign up at bloomberg.com/newsletters or check out the link in the show notes, but it'll take you right to it. Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
Okay, I'm putting that down as a first. John actually remembered to introduce himself.
Yes, I'm getting
there.
there.
The other weeks where he just sits there and waits for me to do everything. Right, listen, John, we've got a few important things to talk about. I'd say some people would say that farmers' inheritance tax is not the most important story of the week. I would say it might be the most important story of the week. So they're very, very angry. You've written about this. Why are they so angry?
Well, they're angry because they're being asked to pay inheritance tax and they weren't being asked to pay it before.
Fair.
And everyone hates inheritance tax in the first place for reasons we can talk about if we want to, but probably not. But more importantly, the issue with farmers, actual farmers, and a lot of them have made this point, is that their land is worth a lot of money, but it doesn't generate a very big return. In fact, from some of the figures that they put out, you're like, how does anyone live on this? It's below minimum wage
sort
stuff.
of less than a 1% return on
exactly.
capital, a 1% return on the value of the land.
Yeah, and so basically if you get charged inheritance tax on that, even though it's at 20%, and even though, broadly speaking, is over £3 million.
No, it is not. It's over £3 million if you've got a wife or a husband who you can share it with. And I have to say, I was speaking to a farmer the other day who said to me, when a government gets to the point where they're grasping at straws, like, if you're married, it's more, they're really in a whole pile of trouble.
But it's not
really 3 million then, is it?
No, it's not 3 million, but how many single... I don't know how
I have no
this
idea,
stuff
but we
works,
don't normally make. In fact, we very explicitly have not over the last couple of decades made policy to suit married people. We have not made a big thing out of using the tax system to incentivize marriage.
Yeah,
so to now turn around
true.
and say, do you know what, farmers, get married, is slightly weird policy take. Anyway, that's an aside. I'm not going to get bogged down in that stuff.
Debate that one slightly, I think, just because there's the no rate family residence. There's loads of stupid things,
okay.
But
another time. There'll be a whole personal finance podcast on why you should get married.
We should do that. Anyway, right. Sorry, let's.
Although it's nice to be married too, by the way. It's not just money, right, John?
Yeah, and also, actually, why don't people get married? It's like this whole thing.
Right, stop.
Stop.
Stop. Right, farmers. So farms are farmers are not making much money. There've been big cuts to their subsidies, a big shift in the way subsidies are paid, away from acreage towards more, sustainable biodiversity, blah, blah, that kind of thing. Lots of uncertainty, nasty supermarkets, very low margins, rises to minimum wage, NI, all the stuff eating away at their income. We see this very low return on capital. Then you get whacked with a great big inheritance tax bill, and they say, well, it's all fine, you get 10 years to pay it, but if you're making almost nothing, paying £500,000 or £800,000 or whatever it is from your £5 million farm, isn't going to happen anyway. So they end up selling. And there's an argument about how many people will pay this tax and how many people will have to sell, etc. Numbers range from the government saying almost nobody, only a third of farms will be liable, 500 farms a year, it's almost nothing, to other people saying basically it's everybody except for the hobby farmers. And if 500 farms a year are hit by it, and those are the medium-sized farms, because let's not forget that the very, very big ones will have a way to mitigate, and they can also sell bits of land without destroying their family's livelihood, etc., etc.
Yeah.
So up the top, probably fine. Down the bottom, the hobby farmers, etc., the people with other jobs, also fine. Who's not fine? It's the people in the middle again.
Yeah, that's the fundamental problem with inheritance tax generally as well. The people at the top pay a much lower actual rate than the people who are just getting caught by it, even amongst townies like me. The practical issue underlying this is that the reason inheritance tax wasn't charged on farms and wasn't charged on business property is because you want family businesses and small businesses to be able to go through succession which is already a very traumatic period for all businesses, without also getting hit with a massive kind of like tax charge, which basically boils down to a tax on your lack of luck and possibly, with enough planning and enough resources to devote to planning, you can minimise inheritance tax. This hasn't done anything to do that. And the government basically says that it wants to target people like Jeremy Clarkson or Dyson, who do own an awful lot of farmland, and that's, at least partly because of its tax efficiency.
Which they've both said in the past.
Yeah, and
that
it's
they
also
buy it for
completely
their tax
valid.
efficiency. It's totally valid. You have a large amount of money, you want to pass it down to your kids tax-free. Why would you not buy farmland and do that? And then, of course, if you do leave it to your children tax-free, it resets for capital gains tax, doesn't it? Post IHT or non-IHT. So someone can then sort of flog it on for nothing, for no tax paid immediately afterwards. So it was a great way to preserve the value of your estate for your heirs. And I totally see that you might say, you and I might say, let's just get rid of inheritance tax. This is a terrible tax. It ruins lives, doesn't raise very much money. Everyone hates it. Just be done with it. But clearly the government is not going to say that. But if you must have inheritance tax, this seems like a really bad thing to add it onto. Yeah. If we want family businesses, farms and other family businesses to have multi-generational lives, which we're always saying we do. We want to think long term. We want businesses to stay in families. We want them to grow in families, etc. This is exactly the kind of thing that will prevent that happening. So this is not just about farms for me. I think that the farmers have valid points, and I think anyway, not everyone will agree that the cultural inheritance of the UK's farming sector is important as well. Not everyone will agree with that, and I understand that. But it seems to me this is about all sorts of businesses.
Yeah, and I think it's more that. It's regardless of your feelings about farmers or otherwise, one way or the other, the point is this is a very disruptive change for businesses. And the reason that it wasn't there in the first place is because that was recognised as being a problem. The way that Labour's introduced it has just made that a problem, and it hasn't addressed the things they ostensibly want to capture, which is that they want to basically stop people from using what they describe as a loophole, whereas it's just one of the rules and this is one of the side effects. And that's not going to happen. And I thought your idea, which some other people have echoed as well, that as long as
first, I'm sure
I think you probably did actually, but as long as it's a going concern, as long as you're still using it as a farm or as a business, then the IHT liability should only kick in as soon as somebody either sells the farmland to use for something else, or they sell their business, or the business goes public, say, and then at that point, it could be charged on the business.
Yeah, and with that in mind, if you wanted to, you could make it 40%.
Oh, exactly.
If what you're trying to do here is encourage longevity of a business, it doesn't really matter what the rate is on sale. You could align it with other inheritance tax rates. And the other idea, by the way, that was our first thought, that what you could do is say, okay, you have to pay inheritance tax, but you don't really have to pay it unless you sell. Yeah. And also the idea being that that liability arrives on death, on the farm being passed down, but it then declines over the years. So if you keep the farm for 10 years, then by the end of that 10 years, the liability is probably gone, right? But RSM, the accountants, they had another idea about putting IHT to one side completely and saying, well, actually, why don't we do it another way and have these assets attract capital gains tax? So at the moment, if you die, the capital gains on any of your assets are effectively wiped out for tax purposes, right? Which is kind of a weird glitch in the UK tax system. Yeah. So how about, this is their idea, instead of the capital gains liability being wiped out, it remains, and in the same way we've discussed with inheritance tax, it stays with the farm or business until sale, at which point it's payable.
Yeah, I think that makes an awful lot of sense.
So basically, you're delaying tax payment until the money exists. Yeah. And this is one of the weird things about IHT in this context, is the best way to get in big tax revenues is to charge people tax when they have money, which is one of the reasons that we've discussed this before. We don't understand why it is the buyer who pays stamp duty on the exchange of a property as opposed to the seller, who's the one with the money, the seller. And if the purpose of tax is to raise tax revenue, then charge people when they have money, not when they don't have money. And that's the big flaw from the purposes of a revenue collector in this idea. This stupid idea.
The other thing, though, I did want to very quickly ask, if we've got time, is...
We have time.
Because I am baffled by the fact that, from a financial person's point of view, the idea that you've got this asset that is somehow worth millions of pounds, but the yield is sometimes sub 1%. Why don't you sell it all and put the money in gilts? Is the way that our mindset works. And it's also, how can anything have a yield of 1%? It shouldn't. The yield should be at least 5%, which means that the capital value of the land should come down. So what is the story there?
Well, there's a lot of competition for land, isn't there? There's the actual farmers, and actual farmers, generational farming families, they don't want to sell their land. They like being farmers. They like living on that land. They like their lifestyle. This is what they want to do. It's what their families have done for generations, etc. Why would you not do that just because the land underneath you has changed in value? Right? It doesn't make sense to farmers to sell the land. They want the land. And then there's competition for land from the lifestyle farmers, people who want big gardens, people who like to have estates, people who, like to shoot or whatever it is people like to do on land. Land is something people own for reasons other than just to make a yield from. In that sense, it's a luxury product as well as being a utility product. It's both things. And that's something that can make the price high. And then, there is argument about whether the tax relief has pushed up the price of land or not. I would say it probably has, because it certainly pushed, as you say, the Clarksons and the Dysons into the business of trying to buy land. And there is a conversation about the extent to which the subsidy system changes the price of land. Did the price of land in the UK start going up when the European agricultural subsidy system was changed, such that subsidies were paid per acre as opposed to whatever it was before, which I can't quite remember, I'm afraid. So there was a change there, and the price of land did look like it started to move then. And the other thing to ask is just, is the price of land in the UK simply a function of the everything bubble? You look at a graph of land prices, they definitely do start to go up before interest rates started to fall dramatically, but they go up a lot faster as we move into the zero interest rate world. So
and also
it's part of the everything bubble at the same time.
Between 2000 and 2007, they rocketed. And because I guess the other issue is the commodities bubble was around about then as well. And they seem to have gone up a lot with the kind of soft commodities bubble, because they didn't dip much in 2008, which was interesting.
Anyway, so there's a lot going on here. And this change to the tax rules seems like a bad thing. I can't see the government backing down because, they look so bad already. Why would they make it worse? But between us, John, we have just given them a way out. Rachel Reeves, we've offered you a way out. Take it. Save yourself. Right. What else should we talk about, John? Talk about inflation, because this isn't going to do anything for that.
Yes, it's not going to do anything for that. Well, the inflation data just came out this week, and it came in a little bit higher than everyone was expecting. 2.3% instead of 2.2%. It's not so much a big deal in itself. It just points to interest rates staying higher for longer. And, the Bank of England, it's interesting because, Andrew Bailey, about 6 weeks ago, after the Fed had cut interest rates by 0.5 percentage point, he was kind of like, we might need to get more aggressive about this. But he very quickly changed his tune because, the US data keeps coming in quite nicely. And UK inflation is now likely to be hitting 3% at some point next year. So it's going to be very hard for them to do very much with interest rates except lower them very gradually. And I think the biggest impact from that is that the housing market is probably going to stall again because mortgage rates are going back up. They dipped to they got almost as low as about 3.8% earlier this year for a 5-year fix. Now you can't get a 5-year fix for below 4%. I was seeing an email from L&C told me that this morning. So I think that. I think it's been kind of like upbeat on the UK economy roughly since everyone was panicking about it back in 2022. But now it feels as if I got to back off a bit. It just feels as if it's getting, everything's looking as if it'll stall. Consumers are getting slapped around by the government. It's not really an environment that feels like, let's go for growth.
Yeah. But listen, here's your regular reminder that there is no correlation whatsoever between a country's GDP and the performance of its stock market.
True.
So do see, we're not going to talk about the UK stock market now, but we're putting a link in the show notes that you should click on that talks about the UK stock market and why it might just be a global safe haven at the moment. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and at John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net. Want to listen to episodes of Merryn Talks Money ad-free? Become a Bloomberg.com subscriber today. Check out our special intro offer right now at Bloomberg.com/podcast offer. Or click the link in the show notes. That seems easier. You'll also unlock deep reporting, data, and analysis from reporters around the world. If you're already a Bloomberg.com subscriber, connect your account within Apple Podcasts to listen to this episode ad-free.